Hello everybody, welcome to Macro Atlas. Today we're going to be discussing a lot. First, the reclaim of the rising wedge and what signs we had that the breakdown was not confirmed. The two theories of how long this consolidation period could actually last, what possible areas of resistance that we can see and predict and watch out for a potential trend to the downside again, and what levels we actually have to break from that consolidation range to confirm the breakdown and what levels we could reach, right? So a lot to cover. We will try to touch on them slowly and try and explain them the best as I can. So first of all, my name is Mo. I'm a crypto and macro market speculator. I've been an investor for the past 7 years, and I was able to turn a humble amount of capital into 6 figures this cycle. So if you would like maybe to learn some of the mistakes I've done and some of the things that worked out well and the analysis I do, then continue watching. And if you like, please consider liking the video and subscribing. First, the reclaim of the rising wedge. So, of course, we had a breakdown, but it was not a confirmed breakdown like the previous one we had there, right? And we had discussed that breakdown, we discussed the rising wedge there, and we were able to anticipate and speculate on the trend continuation to the downside. Of course, our bias remains that the break from this consolidation phase will be to the downside, and that's primarily due to the fact that macro conditions and geopolitical tensions lean more towards bearishness than bullishness, right? I know a lot of people don't like to hear this, but let's trade the market we have, not the market we want. We have to kind of take any bias outside of where we want the price to go and actually look at the true picture. What direction is usually defined, right, from macro conditions. The timing now can be difficult because markets can stay irrational longer than you can stay solvent most of the time, right? This is why we have to take it level by level. And instead of acting emotionally and being active at trading, which is a mistake I always do. You know, everybody loves trading, but actually, like Jesse Livermore says, it is my sitting that makes me my money. You heard that? It is my sitting, not your trading. It is waiting. It is waiting for the right moment. Because you could be right about the direction, but again, a lot of traders get death by 1,000 cuts before they're actually proven right. So not only direction is important, but timing. All right, and that's what we try to analyze on this channel. Not only our macro bias, our directional bias, but actually how we can get the timing right and how can we not die a slow death through 1,000 cuts, right? Which what many traders fail at. They can very often be correct about the direction, but we do emotional and active decisions rather than reactive that make us do bad decisions at certain times. This why we had this rule right here. In the previous video, we discussed it, the breaking of the rising wedge, right? And we said, yeah, this is a breakdown, but it's not confirmed. The breakdown is only one of the things we look at. And then to confirm the breakdown, two of these three things actually have to occur. One, you have to have higher volume on the breakdown, which we did not see. The volume was pretty low. You know, we have seen decreasing volume ever since, which is a good sign for the bears still, but does not confirm the trend continuation pattern to the downside. We saw retest of the support, right? We retested once, and then we failed to retest it again when we broke above. This was 1 point. A continuation candle. Continuation candle can be seen from here. That's what we kind of confirmed that breakdown. We had a retest, a second retest, and a continuation candle. That's why we were confident about our the trend that we devised and of the breakdown of the consolidation phase. So we had here around 6.5%, but here we can kind of averaged around, if you take like this candle, which is the average size of this place, is around 3%. So the candle here was double the size of the average candles here, right? And maybe if we take that one here, the longest one of the range, that was around 3%, 3.5%. So 6.5% was around 1.5 to 2x larger than the previous candles in the range. That's why here it was a confirmed breakdown. But here only one point had sufficed, which was a retest. But the second retest failed. And there was no continuation candle and there was no increased volume. Therefore, the consolidation phase continues and the rising wedge pattern remains intact. We have not shifted into a new pattern yet, but we are continuing in that range. So that's the first update of the on the rising wedge, right? Now we're going to discuss the two theories of how long could this range last for. One theory is you would need oil prices to remain elevated for around 90 days by maximum, right? That's 2 months here, but 3 months is even better. That's why we have the 90-day decision time. So it could happen anytime within that time period from around 2 months to 3 months. Oil prices need to stay elevated for their inflationary effect to start being visible in macro data around the world, especially the USA. So first, oil prices need to stay elevated, and then it transfers to headline inflation, which is the inflation calculation, which includes energy like oil. But for it to really influence markets and for central banks around the world and the Fed especially, we will have to see the inflation data actually come up in core inflation, which is inflation data not including energy like oil. That means inflation has trickled down through businesses and businesses has passed cost to the consumer. And by passing cost to the consumer, the inflation expectation of central banks for the future is increased dramatically. And if that happens, they cannot go with their plans of quantitative easing and they'll have to do quantitative tightening. And they'll have to raise interest rates instead of lower them as expected, or at least remain them at their level for a much longer period of time. So the Fed has probably canceled any rate cuts this year, and the last time I checked, it was at the end of next year they would actually perform some rate cut, and the probabilities of increasing rates has increased rather than decreasing rates, right? So that's where that theory sits. We have a decision period of 90 days from the time the war has started and oil price has stayed elevated, which is around 6th of May, right? With this range builds pressure on economies. This is a macro stress zone. That's why you see tackle Trump chickening out when oil gets to that heightened level, right? So this is the 90-day period. I would expect anything to happen between, 2 to 3 months, so 60 to 90-day period. The second theory actually involves more of a technical approach than a macro approach. Now, a lot of people say we are currently in that zone, right? In that long consolidation zone after the first major move down from the peak to the trough of the first leg down of the bear market, and then usually get the second move down and then some consolidation period, or the consolidation period can be in between those two phases. So if you average all previous such zones, if you take how many days they have lasted and average them out, let's maybe take the 3-day, that would be easier to see. You'd see a similar image being painted, right? So the first major move down, that consolidation period from the trough to the breakdown, and the first crypto cycle, it was around 280 days. Second one was around 280 days again, and the third one was the shortest, around 105 days. So if you take the average was around 232 days, then you actually get a point right here on the 1st of October. That's the second theory. We could last as long as the 1st of October based on technical analysis of similar zone during previous market cycles for Bitcoin. And also, this is where we took 46%. That's that from here, the most recent one. Because other ones are kind of not aligned. They do go up 100% and 152%, which is not reasonable for the cycle since there are diminishing returns and the market has matured. That's why I took the most recent one. Just as a disclaimer right here. So 100% would take us back to the peak. 150 is just making a new high, which is a bull market, right? Which means the bear market thesis in general is canceled, and that's okay. That's okay. We make theories, we put on them probabilistic outcomes, and we speculate on the market accordingly. Nothing can be 100% sure. That's why we need to make sure our stop losses and trades are considering that we can be wrong, right? So that's the second theory. Now let's do some more technical analysis on the levels that we care about, right? For shorting the market, which is something I am doing right now, but of course, if you are thinking of accumulating, then knowing this information is also very valuable, right? Oh, by the way, those are only my trading notes, so I use this kind of information to input it into my trading decisions, and I like to keep it raw so you see the full picture, right? This is the accumulation zone, but this is an invalidation zone. What that means is that if we reach that level, then the upside is more likely than the downside. And why is so? Well, breaking that level to above that level would actually make us reach almost the consolidation period of the midway of the first leg down, which risk assets do not usually do that in bear markets, right? And that's a major level to break. So it's a good place to reassess the situation and the pair thesis, because here Bitcoin actually went around what, 21%. We should aim for something similar due to recency bias and similar market conditions in a way, except now right now it's more volatility and there's higher uncertainty, which can shift that by a few standard deviation, I think around 1 or 2. Right now we reach around 26%, but reaching that zone would put us at around 40%, which is something difficult to expect for a mature asset like Bitcoin right now, especially when institutions are getting into it. That would be too volatile. But if we go up to that zone and get rejected from there, then this should be a no trading zone in general, right? Like, you should just ignore whatever happens here because that's just noise. It doesn't really add much more information to speculate on, right? Those ranges is where most traders get, death by 1,000 cuts. Therefore, if you're looking at some levels where you might accumulate for going longer or shorter, I would actually consider only that zone, because invalidation would be here, invalidation would be there. That's nice, right? Here, you just don't know what's happening. Let's say we go up here and we actually shift to the downside again. If we take that path, right? Say we go up there and we actually start going down. Then going to this level right here would actually give the theory that we are going lower for longer is more probabilistic than not, right? You would need to see a weekly close there or a 3-day close there. Multiple 3-day closes would be nice to actually confirm that zone, the information that you get from that zone. Not just a week, not just one close. A weekly close is very preferable. After that, if we continue down here, then the thesis that we will get trend continuation to the downside is just spectacularly high, and I would not consider going long there, okay? The first zone where we could actually reach and we might find good support would be around the 48 to 54,000 per Bitcoin. But where I'm really aiming for is around 43 to 48,000 a Bitcoin. And we did analysis on this many times on why we think those levels are actually viable. One way on how you can do that very simply at home, do it yourself, is very easy. You just do that recency bias does it spectacularly well always. And you take, for example, the high range and you do that and you get an idea of where the price could go. If you're not sure about that, you can try it here and you see that the drop down from here to here was actually quite close, right? So those are the levels I am looking at. We have talking about that. Some major resistant areas are actually coming as well from moving averages. So the 100 daily SMA is right here, around 76,000 a Bitcoin, right? And previously we actually got rejected from that area, right? That's why I think this is a nice place to consider and to put emphasis on as a possible place to find rejection if there is one. If we reclaim that level, then the probability of going higher increases. But if we get rejected from there and we see a continuation come to this downside or higher volume on the rejection, then the probability of going lower increases. So each level, each rejection, each breakout gives information, right? But any trending areas like that, I consider them as low information areas. I do not like to gain information from there. I like to gain information from above or below, because that's where it is meaningful. Another EMA, well, before it was an SMA, now it's an EMA. The 100 daily EMA also sits around that range, a possible rejection zone, but also the bull market support band sits within that range, around the 79,000 a Bitcoin. And previously, again, we had been rejected from there multiple times. So the thesis that the downside is coming could be tested on those levels. That's what we should look out for. Reclaiming or retesting the, I believe it's the 100 weekly SMA is highly unlikely, as it is quite far. But it is possible. It is possible. It's not off the table. I believe we would need large macro or regime shift for us to reach that level. And if we reach it, I'm more likely to be bullish than bearish after that. We will see what happens. But if we go check history, when we break from that level, we don't actually reclaim it till the next bull market cycle or so. We might wait below it, but usually it's a reliable level to look at in bear markets. Here we broke it in bear market and we only reclaimed it in bull markets. So I would expect the 100 weekly SMA to be a major player in this cycle of deciding whether the bear market is canceled or not. But let's take it level by level. Let's watch the bull market support band. Let's watch the conditions, the macro bias that's going to be devised through continuously shifting dynamics in the market. It has been very hectic with this global tensions. So safe trading, my guys. And I hope you enjoyed this video. If you did, consider subscribing so you don't miss the next time. We'll see you next time.